All right, we are good to go. I'm so excited for today's conversation. So I met Stephen Robert virtually by taking a class about credit last year as part of my real estate continuing education. And I learned so much. And I also learned that I was doing almost everything wrong. And couldn't figure out why I couldn't get my credit score any higher. So, and all the mistakes that I think that so many people don't know, and working with many buyers, I think that this is going to be very great for them to see and hear. So I'm very excited to introduce Stephen Robert, who is the CEO of Bedrock Credit America. And for the past 16 years, he has been helping people understand how credit works and what they can do to fix it. So welcome, Stephen. I'm so excited to have you.
Why, thank you so much, Christine. I'm excited to be here and excited to give everybody the information they need to know about credit.
Great. So let's just start with some simple questions, and then you kind of take over here. But tell us, what is the difference between a credit score and a FICO credit score?
Absolutely. That's probably the question I get asked the most, because people are constantly saying, well, I'm using this free website and
Right.
I have a 700 score, but then the lender pulls credit and I really have a 620. And what is going on here, right? So bottom line is there's apples and oranges. And you have all these third-party websites that are giving you credit reports and credit scores that can range anywhere from 100 to 1,000 points. But that is not what lenders are using. Those credit reports and credit scores are there for illustration purposes, to kind of just give you a general understanding of what's going on with your credit. You might be able to see your history, or if there's an inquiry, something of that nature. But when you actually go and apply for a loan, specifically a mortgage, all lenders in the US today are using something called the FICO credit score.
Okay.
So third-party scores, FICO credit scores, and then we have to get more complicated than that, because why not?
Right.
So within the world of FICO scores, because now you look at it and say, FICO scores, I think I've heard of that. You know what? I saw it on my bank statement, or I saw it on my credit card statement, right? And that has to be, okay, a FICO score, I get it. Now, wait a second. This says I'm at a 720, but the bank pulled credit, I'm at a 680. But it's a FICO score. I don't get it.
Right.
Well, there's different versions of the FICO score. Yes, why not? Let's be more complicated.
Absolutely, exactly.
No. The way that it works is, in the year 2000, they built FICO Classic. And since then, that's what all lenders in the United States are currently using. Now, they are going to be making changes to that in the next 12 to 24 months. We don't have a direct timeline, but Fannie and Freddie did say as of November 2022, they will be making changes, but we don't know when those are going to be happening yet.
Okay.
So we're stuck simply with FICO Classic. So FICO Classic is the system that all mortgage companies use, and that was developed in the year 2000. In 2008, they built FICO version 8. 2014, they built FICO version 9. 2020, they built FICO version 10. All these newer versions, and they pass those out to the public, but those are different scoring models compared to the FICO Classic.
Got it.
So you have apples and oranges, and then you have green and red apples. If you want to be,
it's all very confusing.
Yes, it is. It really is. The good news is, however, the baseline of what goes into your FICO score is basically the same, regardless if you're using FICO version Classic, 8, 9, or 10. They all have the same parameters of the understanding of the 5 components. And we'll talk more about that in just a moment.
Okay, but why on like a credit card statement, why aren't they giving us the FICO Classic?
Because they know the newer versions, FICO version 8, 9, and 10, are better predictors of risk. And from a credit card perspective, that might be what they're using to determine if you're going to qualify for a credit card and such. So really that FICO Classic is, we're getting stuck in the world of the mortgages. And that's in the world that the sandbox we play in with me, you, and the lenders, because that's what we care about. But that's the answer, is that newer versions are better predictors, and that's what they try to pass out to the public. But again, just not relevant really to the major purchases.
Interesting. All right, I'm taking notes because I'm going to have more questions. All right, and how to deal with negative information on your credit score.
Yeah, well, 35% of our score is the biggest chunk of what makes up our credit, and it's past delinquencies. So that's your payment history. Do you have a new late payment? Did anything ever go into charge off or collections? whether it's an auto loan that went to collections, whether it's your credit card. What about that $50 medical copay you didn't even know about that just hit your score and drops your scores 100 points?
Right.
That happens on a daily basis. But there's a lot of different things to say based off of what the accounts are. The good news we're going to start with is as of July 1st, 2022, the credit bureau has passed the new regulation that any paid medical collections will be deleted off your credit within 30 days.
Wow. Okay.
So that's huge because now that $50 credit card, the $50 copay you forgot about, or you had an extra bill for $200, now once it's paid, because it's medical, within 30 days, it'll be deleted.
Okay.
Now, that's great news. The not so great news is all the other types of collections or charge-offs. So credit cards, old cell phone bills, of repossession, an old apartment complex that sends into collections, all that type of stuff. Those are your traditional charge-offs and collections, and you can't just pay them and have them removed. That's not how the system works. Okay. So when there's any type of outstanding charge-off or collection, we need to verify the debt. We need to see if it's legitimate or not. If it is legitimate, we need to try to do a settlement with them, a one-time settlement. We never put ourselves into a payment plan. Of course, we need to obtain a settlement letter. And then when we're ready to pay it, we never, ever give out debit card, credit card, or your checking account information. We have to financially protect you, which means we only give out a money order or a certified bank check. That way they don't have your finances.
Interesting. And why don't you do a payment plan? Because again, you don't want to give out the credit card information.
Because you don't want to give out the credit card information. And also, after doing this for 16 years, I've seen companies that you're in a payment plan for 10 months. Month number 8 comes, you go to make your payment, and they say, oh, we don't have the account anymore. We sold it. Oh, what do you mean you sold it? I've been paying you. Yep, no, we sold it. Go talk to them. All right. So, hi, yeah, I'm calling because you have this account now. Oh, yeah, you owe us the full $1,000. No. I've been making a payment plan for 8 months. Nope, sorry, we don't know what you're talking about. You owe us the full balance.
Right.
There's a lot of shifty collection companies out there. So you don't want to be put in that bucket at all. You want to just make sure you're protected. Also with the understanding that if the account gets paid and it goes from an open collection, well, let's say it's older, let's say it's from like 2019. So it goes from open in 2019 to paid as of 2023. If it gets paid and it stays on your credit report, it's actually going to drop your scores because it's updating something called the DLA, date of last activity. And in updating that date of last activity, whereas logically you're thinking, well, it was open and now I paid it. That's good, right? Nope. If it's open and it gets paid, but it's now a more recent event, that's going to drop your scores.
Oh my gosh.
So it can be very frustrating for somebody that's trying to work on their credit and understand what they should really do with their credit. So the part of the service that I can offer by representing as a power of attorney is to make sure that we do pay it in a way that protects them financially, but also work with the credit bureaus to make sure we're removing the negative data.
And did I hear in the class that I took that for medical bills that you should call your medical establishment and not the credit that you get the letter from saying that you owe?
That usually can expedite it, and it certainly was the case before is July 1st, 2022. Now, because of this new regulation, it's a little bit less relevant. Again, you still want to protect yourself financially, and even if you're calling the collection company because you went to Dr. Joe, you want to make sure you pay him with a money order or a certified bank check just to protect yourself. But ultimately, doesn't really, at this point, it doesn't matter so much who you pay anymore because of that new regulation.
Got it. And then just because you talked about paying things off, bills off, so I paid off several credit cards and then I closed the account, thinking I was doing the right thing. Can you talk to us about that? Right.
So you never want to just pay off an account, and you're obviously talking about account in good standing, right? You're making your payments every month, you're building positive credit history, and for whatever reason, oh, they're charging me an annual fee, I don't like that, or you know what, I barely shop at this store anymore, or hey, I haven't used this card in a year, and you just forgot that you had it, and then all of a sudden that inactivity gets it closed. So whether they close it due to inactivity or you close it just because you think, okay, I don't want to have that card anymore, closing your credit can really hurt you. And number one, it hurts you because it can stop you from building positive credit history. And eventually you say that card was 10 years old, eventually you're going to lose that 10 years of positive credit. So that's it. You're not going to lose it right away, but eventually over time you will. And the other side of that is your debt utilization. Think of it
Right.
this way, and I use this very simple example. If say on your entire credit report, in terms of revolving debt only, you have two credit cards. Each one has $1,000 limit. Well, this card you max out every month, and this card you barely use it, and it's a zero balance. So right now, our utilization percentage is only 50%.
Right.
Okay? All of a sudden, you say, you know what? I'm tired of this card, or I don't like the annual fee, or you forget about it, and it goes away.
Right.
Now, what's our utilization percentage?
100%.
100%. And what did that just do to our scores? Whoop, just dropped them.
So
As simple as
fascinating.
closing down a card where that
Right.
extra $1,000 was giving you a utilization, now that goes away, jacks up your utilization percentage, and that's going to hurt your score because 30% of our scores is that debt utilization.
Right.
So that's another huge chunk. So you got to pay your bills on time, deal with your collections, and then you got to make sure you're utilizing your cards in the best way possible. My general statement is, I don't care if you have a $300 credit limit or a $30,000 credit limit. The most you should put on your credit cards every month, $10, $20, $30. Let's say $20. Put $20 on your card every month. I used to say put a tank of gas, but can't say that anymore, right?
Yeah.
So put a tank of gas or whatever it is, 30, 40 bucks on your card, wait for the bill to come in the mail, paid in full. If you're doing that, you're building and establishing positive credit history. You're allowing yourself to have a nice low debt utilization, and you're going to be headed in the right direction. I've actually had people say, well, I thought if I have this $1,000 credit card and I put $1,000 on it and I pay it off, I'm getting bonus points for showing that I can handle that.
Right.
You're not getting bonus points at all. The only bonus points you might get are like rewards points because
Right.
travel points or something like that. And you can go to Tahiti, good for you. But other than that, it's not helping your credit. So don't do that. Only 20 bucks and then pay it off and you'll be good to go.
And for somebody who is trying to pay down their credit card debt, does it make sense to get one of those 0% interest credit cards and combine it all on that? And will you even get that credit card if your credit score isn't that great?
It's unfortunately one of those catch-22s because if you have great credit, they'll be like, oh, here's a $10,000 credit card. You're like, I don't need it. But if you have subpar credit, maybe there's a late payment in there or something like that, and now you're in the mid sixes and you're like, oh, I wish I could just get a credit card to transfer the balance.
Right.
Then they might not give it to you. In theory, sure. If you open up say you have 3 credit cards and now you say, let me grab a 4th so that I can transfer these 3 onto this one.
Right.
And in a perfect world, they do it. It's 0% transfer for 12 months or whatever. That's fantastic. You do take a hit for the inquiry. You do lower the average age of your credit file, but that's one of those tactical things from a financial standpoint where it could help make sense. And as long as you keep these 3 cards open, it's also going to help your debt utilization. Because now if you were maxed out on these 3 cards and then you put them over here, and now all these have a 0%, zero balance, and you keep them open, you might be at 50% utilization by just opening that card. So that can be helpful. So definitely one of those kind of tricky situations where you just kind of want to really look at the numbers, but it certainly could make sense. The one thing I always tell people to stay away from are the debt consolidation companies or the settlement companies, right? So, oh yeah, you work with us and we're going to consolidate all your debt. Well, the way they consolidate it is by stopping to pay the bills. The accounts go into charge off and collection. It absolutely destroys your credit. And then eventually they go in there and try to get it paid. But when they pay it incorrectly. So now you're left with all these accounts that went negative. They might eventually pay off the accounts if you go through the whole program, but now you're left with all these paid collections and charge-offs, and now you have to rebuild your credit as well. Stay away from those debt management type of companies.
Okay. And then what about if you call a credit card and say, can you increase my credit limit just to get that higher, credit limit?
Absolutely. 2 ways to do that, right? So the first way to do it is, hey, I had pretty good credit and I've always paid on time for the past 3 years with this. Don't pull my credit, but I want you, based on my credit history, give me an increase, $500 to $1,000. I don't want to take it for the inquiry though. So that's step number 1.
Okay.
Step number 2 would be, okay, let's go in there. I had not so good credit before. It's been 2 years. My credit's really on the up and up because I've worked with Stephen Robert at Bedrock Credit America. Things are great now. And so now I want you to pull my credit and I'll take a hit for the inquiry, but go ahead and raise that up. That inquiry may be 5 to 10 points, somewhere in that range, But if
Okay.
it increases your utilization, your limit, and therefore lowers your utilization, that could be very beneficial.
Okay, great to know. Wow. Okay. And what is the right, well, not ideal, but for home buyers who, first-time home buyers, and they're trying to get, that good credit score, what's the minimum? What's the best? Talk to us about what they need to do.
In terms of your scores you need to have, or just the
Yeah,
overall
for,
platform?
for applying for a mortgage, yeah.
So they
Would you like me to take that one, Steve?
Well, yeah, Steve can actually talk to us about the numbers, right? Because Steve, you being a banker, you can kind of relay, there's different types of products based off of different scores. Is that correct?
Got it. Okay.
So typically you're looking on a conforming loan, you're looking at a low score of 620. Anything over 620 is bankable. On jumbo,
Okay.
we're looking at 680.
Okay.
Okay. The difficulty that you have is that if you've got a 620 credit score, your cost of financing is going to be substantially higher than it is if you're in the sevens.
Right. So it
So if
makes
you're up
sense.
to the
Yeah,
Right.
it makes sense. If you can get yourself from that 620 up to that 700, 720, you're going to get a much better situation, right?
Okay.
Yeah.
Got it.
So you're going to end up, and particularly if someone is paying, if someone's doing, a low down payment loan, they're putting down, 3-5%, where they're really going to get bludgeoned on a low credit score is going to be the private mortgage insurance, even more so than on the rate.
Oh, got
So
it.
you can have something where, if I've got someone that is in the high sevens, and let's say they've got PMI of $100 a month. If they're down at 660, it might be $300 a month.
Wow.
That's a big difference. Yeah.
It could be
That's
a
huge.
huge difference.
So,
And,
go ahead.
the other thing that we like to see is, we used the example before of someone that's got, 2 charge cards. They run up $1,000, run it to the limit each month, and then they pay it off, which is fine. The two issues that I see, one is if you've got the $1,000, pay the thing off, not on the due date, pay it off just prior to your end of charge period, because that's what's going to get reported to the credit reporting agency. So if you pay it off before they actually bill you for it, that's going to have a very positive impact.
Okay.
And the other thing that I've seen, which is more of a negative that I've had to educate buyers on, is that they run it up, they carry a balance every month. They run a card up below the limit. I didn't charge over my, the balance that I'm allowed. But then they have interest that's added on that last day. And it puts them over the credit limit for that card. And that really just kills them on their credit score.
Interesting. That's good to know.
Yeah, Steve, that's a very good point, because if you have utilization, the higher your utilization the lower your scores are going to be. And there's different buckets in terms of how it actually operates.
Right.
But I think that the bucket Steve is talking about is if you're at 100% utilization, there's one called 100% plus, where you're maxed out and then you're even going over that limit. And that's really just hitting you on a whole nother level in terms of how that's impacting your scores.
Yeah,
So,
that's great to know.
Handling the debt utilization, really important. Making sure you have enough accounts. I constantly see people that say, well, I only have one account that's open. I have an auto loan and that's all. I've always paid cash. Well, that's great that you can pay cash, but you need to start building and establishing positive credit history. Let's have you open up some secured credit cards to be able to get through that process. So having that on there and starting to build that positive credit history is something that needs to be done as well. And if there are issues like late payments or they paid their collections, we need to work with the credit bureaus to remove those. If there's open charge-offs and collections, we need to make sure those are getting paid off in a way that's financially protecting the client, but also allowing us to remove the negative information.
Interesting. And if there's like one late payment, say back in 2019 on one card, is that worth fighting for? Or
yeah, I mean, here's the bottom line. Once you have a late payment, that late payment, depending on exactly what your credit profile looks like, can hurt you anywhere from 20 to 30 points up to 80 to 90 to 100 points.
Wow.
It's absolutely mind-boggling that you could have one late payment that it drops the score over 100 points, and I've seen it happen. And
then how does one go about doing that?
But the good news is it diminishes over time. So say there was a new late payment on a Chase card and it hit you 70 points last month. Well, 6 months away, it's going to be down to 65 points. 2 years away, it's down to 50 points. 5 years away, it's down to 18 points. So it will diminish over the course of time, but technically it could stay there for 7 years from that date, that time that happened.
Wow.
Diminishing over time, therefore getting your scores to increase. Now, there's a lot of errors. Ever since COVID hit, there's been a lot of people working from home, a lot of changes in how businesses are run, and there's been a lot of errors on the back end of a lot of companies. So number one, you always want to stay on top of it. Even things like auto pay, where people rely on it very heavily, that's there as a tool, but it's not an excuse. So if the auto pay doesn't go through, you can't blame it on the auto pay because you're the one that's responsible for it. But if there is something that is actually verifiable, like, hey, listen, this was a problem they caused, I sent in the payment, I did what I was supposed to, and there's an error, you need to have a conversation directly with that creditor as soon as possible to get it resolved. Going directly through the credit bureau can help, but if the creditor themselves thinks that this negative piece of information is accurate, when the credit bureaus get it, they're going to say, yeah, it's the same. But if you can tell the creditor and show, hey, listen, this isn't accurate, here's why, and they go, oh, you're right, we made an error, we'll correct it, then it will get itself retracted from the credit and significantly help the scores.
Great. Wow. Good to know. Okay. And so how do inquiries work if one does need to get an inquiry for a home loan or for a credit card?
So inquiries are always a head scratcher to me, because going back to that example of, well, I had a 700 score and then Steve pulled credit, it's down to a 620, right? My score dropped 80 points because of him. No. Again, inquiries are 10% of our score. It's one of the smallest slices of what makes up our entire score. Okay. That's number one. Number two, you're comparing apples to oranges. So what Steve had is the real one, and you're looking at these third-party websites. And number three, inquiries themselves, maybe 5, 10, maybe 15 points. It's one of those situations where if you have great credit and you apply, you're going to take a smaller hit for an inquiry. Whereas if you have questionable credit and you're applying, well, you're a mess and now you're making more of a mess, well, that's going to hurt you a little bit more. But the good news is, with mortgages and with auto loans, you have a 30-day window to shop around, and you could have 20 people. They say you go to Steve, you go to Joe, you go to Bob, all these people, as long as those mortgage people are pulling your credit within 30 days, all 20 of them will be listed on the report, but it only counts as one inquiry.
Which is great. Yeah, that's
so maybe
great to know.
5 to 10 points only one time, not 5 to 10 points times 20.
Every time, exactly. Like right. Interesting.
And that's for mortgages. And then for auto loans, which I hear constantly, well, I went to this auto dealership, they shot me around to 10 banks, and that's why my credit dropped. No, you have a 520 because you don't know how to pay your bills, not because of inquiries. That's
a good reminder. All right, tell us some tips to how to build our credit.
So number one is start building. If you have nothing, you can start with a secured credit card. If you have a little bit, you can open up a regular credit card. But having those revolving accounts, and the perfect mix of credit is looking between 3 to 5 credit cards. Okay. Now, if you have 2 credit cards, does it make sense to go get another one? Yes, as long as you're not applying for a mortgage next month.
Right.
Because if you're about to apply for a mortgage, and Steve, I'm sure, has seen this before, where somebody's about to get qualified and then they go shopping at the furniture store, open up a new card, jack up the utilization, and the score tanks, and now Steve has to rework the loan, right? So you don't want to do that.
And it ends up being a very expensive process.
Exactly.
You may end up paying more on your mortgage with the mortgage differential than you've spent on all that furniture. So
absolutely. So they should make no big credit card purchases at all, even though they want that new living room set for their new home.
We put that to the side.
I don't know if other lenders are doing this, but the purchase cycle has really stretched out. As we were talking about earlier, it takes so long, not just to find a home, but to have your offer accepted. One of the things that we're doing is we'll do a pre-approval based on a soft credit pull. So that is not hitting you as an inquiry. And with that, we're able to take a look at the credit, so that if I'm going through it, because I've been doing this so long and I've had lots of conversations with Steven, I can take a look at it and make some recommendations, which may end up being, you need to call Steven. But you know, it gives us some insight. And during the process, since we haven't pulled their credit, now if they take those steps and improve their credit during, you know, from pre-approval to the time when they're going to make a formal application, they may be able to improve their credit score and cut their cost of borrowing during that period of time.
Right.
So it's better
Interesting.
for them to be educated up front. And unfortunately, that's not something that they're going to get, you know, if they go online and get the quick pre-approval where they're dealing with, you know, somebody that's just graduated from college and gee whiz, this is my third mortgage I've taken.
Right, right. So tell us, what is the difference between a soft pull and a hard pull? Like, you can see the majority of the credit, but not all the credit.
So it's really just, yeah, they can see the full gamut of it. It's just more of how it's calculated on the back end. Generally, Steve, are your pulls, your soft pulls with all three credit bureaus or just one?
Just one.
Right. So generally, soft pull is going to be with one credit bureau.
Okay.
Right. With a soft pull, we can't make the loan off of that.
Right.
But and that's typically the differential, is that it's not able to be used for lending purposes, where the hard pull we can make a loan on.
Right. And there are going to be people that are listening to this that aren't even ready to qualify yet. And they're like, well, this sounds like this all sounds great, but I'm not ready. I'm another year or two out before I even want to know what's going on. How can I go about this and see that information that the lender's seeing without actually getting it?
Exactly.
Only one way to do it: myfico.com. myfico.com. myfico.com is the only website where the individual person can go get their report without it being an inquiry, without it impacting the score in any way, shape, or form, and see their FICO classic scoring model, along with all the other FICO scores, by the way. And although it doesn't count as an inquiry, they do have to purchase it, and that's kind of the trade-off. And the cost can be anywhere between $30 to $60 for that purchase of that report, depending on what product they want to buy at the myfico.com website. But that will give them the information that they can use and see. And that's what I use when I say, okay, I'll offer you a free consultation. I have them get their FICO credit report, because I don't want to tell them, oh yeah, this is what you need to do to fix your credit based off of this third-party website that's not giving us the full picture. I want to see the same exact information that Steve and everybody at the bank are going to be using. And myfico.com is the only one that gives us that. And
can I go to myfico.com twice a year or 3 times a year?
Oh, you can go every day if you want. You just have to pay for it.
Got it. But I can get that $30 credit thing as many times as I want throughout the year.
Yeah, I mean, they're going to want your money every time. But yeah. Now, if you're saying, well, I don't really need to know the scores, and isn't there something about I get a free report? Yes, there is. Annualcreditreport.com gives you your free 7-year history with Equifax, Experian, and TransUnion. Now, that's not going to give you your scores, but it will give you the content of what's going on with the credit. And that's going to be really important. So you can at least go through and say, well, I don't really care about the number yet. I just want to make sure everything's reporting accurately, make sure there's no surprises on there. Oh my God, what's it? I didn't know I had this Verizon bill from 5 years ago. All right, let me go ahead and get that resolved, versus waiting till Steve pulls it and now he surprises you and he said, yeah, I should be at a 780. He's like, no, you're really at a 690 because you have 3 collections from 5 years ago. And you're like, oh man, I completely forgot about that. So it's better to, as soon as there's any thought in your mind about, I'm going to want financing in the future, which we're all going to want financing, whether it's a credit card, an auto loan, a student loan. I got a co-sign for my kid's student loan, a mortgage, whatever it is. Start looking at your credit now. Look at it as often as you can, just to make sure things are reported accurately. Because if there are errors, it's not, okay, I'll call and fix it today and we'll be good by tomorrow. No. Things take a lot of time. You got to send documentation. You got to deal with the credit bureaus. They have to update that. They have to contact the creditor to verify that, make sure it's accurate. In general, when I look at a credit report and there's somebody say, well, listen, you have a whole bunch of negative accounts, you have a whole bunch of open collections and charge-offs, it's going to be a process that takes anywhere between 6 to 12 months on average.
Wow. Oh my God, that's huge. All right, well, that's great to know. So how can people start building their credit?
Secured credit card. The other thing they could do, because that's them standing on their own 2 feet, is being able to lean on somebody else. So
Right.
maybe they have a friend or a family member that has a credit card that's been open for the past 5 or 10 years. It's a MasterCard or Visa and has no late payments, a nice small balance. And now that person adds them as an authorized user to that card. Within 30 days, that 5, 10, 15 years worth of good credit from that other individual is now going to help that person. And that can
Perfect.
help boost their scores as well. Just a heads up on that, if the individual that is having the card added to them, that authorized user, if they have a whole bunch of negative information, this person's over here like, well, no, I have perfect credit. I'll add you as the authorized user, but I don't want all your negative stuff to come get me. It doesn't work like that.
Okay.
They're getting the benefit. You're allowing them to be an authorized user on your history, but none of their negative stuff can come over to you and bother you.
Got it. So what's the difference between a secured credit card and a regular credit card?
Secured credit card means you have to give them the money in advance. And by giving them the money in advance, you're going to have a higher chance percentage that they're actually going to give you the approval. You still have to do the application. You still have to let them run credit. And there are situations where you could be like, okay, here's your $300. Give me my credit card. And they'll pull your credit. And based on having negative history there, they'll be like, you know what? We're still not going to give you a credit card, even if you're giving them money in advance, which means you really need to start focusing on cleaning up the credit. But the secured credit card is, I'm going to give you the money. Here's my application, run my credit. But because I'm giving you the money, you're going to trust me that I'm going to start being able to use this credit card with a limit of $300. Compared to a regular credit card, which is, hey, I have great credit, pull my credit. And because of that, give me a whole bunch of money unsecured that I can start paying on. And then if I do mess up, you're going to hit my credit with it.
Absolutely. Great. All right. And what is the best way to use credit cards to optimize the scores?
Really just keeping that nice, small, manageable balance every month, $10, $20, $30 on it. If something comes up, you got to put a new tire on the car, you got to pay for your kid's dentist. I get that. But in the grand scheme of things, you want to get that stuff paid off as quickly as you can. Keep that balance nice and low, but also keep it consistent. I constantly have people say, well, I'm going to use this credit card and then I'm going to put it in my drawer. And then they forget about it. And then they try to use it a year and a half later. Now it's already been closed. Now they lost that utilization. Now they're going to eventually lose that average age of the credit file, and it causes a problem. So just be aware of all your credit cards, keep them in a nice safe space, put them on your desk. Like what I do, I just have them on my desk and then I just pull it out every month and I say, okay, there, it's on my desk. I use it. I put it there and I say, okay, now I'm going to wait for the bill to come in the mail and pay it off. And you just, consistency is the key here.
Okay, great. Well, this has been so great. Oh my goodness. Such a wealth of information. It's just incredible. Thank you. Do you have any closing thoughts or anything else that you want to add? And please tell us where everybody can reach you as well.
Yeah, absolutely. So again, Stephen Robert, Bedrock Credit America, your nonprofit for credit education and restoration. The best way to reach out is just to give me a call at my cell phone, which is 617-939-3447. You can email me at stephenrobert@bedrockcreditamerica.org. You know, it's a long one. Obviously, you can go to bedrockcreditamerica.org, the website, get our information from there as well. But anybody that comes my way, I'm happy to talk to you, even if it's just to point you in the right direction. If you have a question about how to handle a certain situation, I'm always happy to give those answers. And the best advice I can give is review things now. As soon as you think about anything, or even if you're not even thinking about anything, you happen to stumble upon this. Now that you've heard this information, go pull your credit through annualcreditreport.com or myfico.com. Look at what's going on, make sure it's accurate. And if there are inaccuracies, work to make sure they're resolved. And if you need help, feel free to reach out to me. I'll give you that free consultation and see if it makes sense for us to work together.
Perfect. Well, thank you so much, Stephen. I really appreciate it. And thank you, Steve, for your input and insight. And thank you, Cheryl. And like I said, I'll be recording this and sending this out to my home buyers. So thank you all and have a great day, everybody.
Thank you so much for having us.
Thanks.
Bye, guys.
Bye.
Bye.